Hello Mavericks, how's it going? This is Rob Reinhold. In this session, we are going to be going over pairs trading. Now, pairs trading is going to be something new for a lot of you. Let's talk about where pair trading started. And really it started with the birth of hedge funds. Now, the first hedge funds, they were created to be what's called market neutral. And the very first gentleman who started this, his name was Alfred Winslow, and he started a fund. It was called the first hedge fund. And his premise was he didn't want market risk. What I mean by that is that when you buy stocks and the market goes down, it affects all stocks negatively. I shouldn't say all stocks. Some do better than others. What he wanted to do is he wanted to create a fund where it didn't matter what the market did. What mattered was how well you picked stocks. So the theory was if he was going to buy $100,000 worth of General Motors stock, then he wanted to be short $100,000 of another company very similar. So let's say a position of $100,000 short of Ford Motor Company. So there's two companies. They're in the same market, same sector, same industry group. They're very similar companies. And he's long 100,000 of GM, short 100,000 of Ford. Now, once he's done this, he's basically said, okay, at this point, if the whole market goes down, both of these stocks are highly likely to go down. But his premise was GM is a better company than Ford, and GM stock will go down less. So let's say that General Motors stock went down 10% and Ford went down 20%. His strategy, his fund would make a profit off that. So again, this was the strategy of the very first hedge funds. If they were long something, they had to be short an equal amount on the other side. By doing this, this created a pairs trade. So it is no longer about, is the stock market rising? Are these good companies? It was more about, can you pick a strong stock versus a weak stock? And that's really what it all came about pairs trading. So let's take a look at just some examples of pairs trading. Let's take banks. So here we have four banks, and clearly the best performing bank was Goldman Sachs during that period. The worst performing bank was Wells Fargo during that period. So you can see here that if you picked to go long Goldman Sachs and short Wells Fargo, you could see that you actually would make a return, regardless of if the market went up, down, or sideways. You can see here any combination where the long side went up more than the short side was a win. However, you can see the bottom one, long Wells Fargo, short Goldman Sachs, would have been a losing trade. Hopefully you can see that this makes it to where it doesn't matter what the market does. It doesn't matter what anything else does. All that matters is, was Goldman Sachs a better performer than Wells Fargo? And if the answer was yes, then you made profit. Let's take a look at what happens in bear markets. So again, in the first scenario, all the banks went up. But let's say that there was a down move in the banks and in the market, and there's a big bear market. Well, if you were long Goldman Sachs and short Wells Fargo, you could see here that Goldman Sachs went down 7.6%. And you can see that Wells Fargo went down 8.8%. The fact that your long was down less than your short, this is going to be a plus 1.2% return. Hopefully you can see here that this takes the market out of the equation. Whether the market's in a bull market, a bear market, a stagnant market, it doesn't matter. This is a pairs trade. This is a pairs trade. Every single currency trade you make is going to be a pairs trade. There is no way to answer the question, what is the US dollar worth? Well, in relation to what? And that's the question you have to ask is, okay, well, we know what the dollar's worth, but in relation to what? In relation to the euro, the yen, Bitcoin, like what are we talking about? So every currency trade is going to be a pairs trade. And we really just have to take a look at returns and performance and our time frames. So let's take a look at a pairs trade over multiple time frames. So let's take this trade of T-Mobile, which is a very strong stock in the moment, and Verizon, which is very weak at the moment. And you can see that today's performance, T-Mobile went up, and so does Verizon stock went up. But if you were in a pairs trade, you get the differential between the two. So T-Mobile went up 2.5%, Verizon went up 0.3%. That would have equated in about a 2.2% return during the day. Now you can see, based on the performance and the time frame, you get the differential. So in this 1 week performance, that was a very nice week because Verizon went down and T-Mobile went up. That's exactly what you wanted to happen on your pairs trade. You get the differential of the two. So this would have been closer to like a 10.4% return. So hopefully you're seeing how these pair trades work, because it's so key to understand this, because it's not just about, oh, I want to buy Bitcoin. You also have to think about, okay, but what about the other currency? Because if you buy Bitcoin, but you buy it against a currency that's also very strong, you may not make any money on a pairs trade. So we're always talking about two currencies. Whatever trade we make, it's always about which two currencies are we going to do. So let's just take a look at the major currencies we're going to be trading. The yen, the dollar, the euro, Swiss franc, pound, Canadian dollar referred to as the CAD, the Aussie, and the Kiwi. Now look, yes, there are other currencies out there. There's no question about that. But these are the major ones we're going to focus on. The major cryptocurrencies: Bitcoin, Bitcoin Cash, Ethereum, Litecoin. Now these are basically our 12 choices. And we have to pick one to be long and one to be short. That's what every trade is going to be built around, is that it's not just about looking at one. You don't just look at, the yen and say, oh, I think the yen's strong. Okay, that's great. You have one half of the equation, but the other half of the equation is, okay, what are you going to pair it against? Again, there's lots of other currencies out there. We've talked about this. The problem is when something is not traded all that often, that's called liquidity. When there's not a lot of liquidity going on, you get some things that happen. First of all, you get much wider bid-ask spreads. Whenever you buy or sell, you're going to be paying the spread. And the wider these spreads are, the more expensive it is. Also, on lower liquidity, you get lots of, funky price action. Meaning that if there is a illiquid stock, currency, whatever it is, one player can come in there and push it around a little bit. They can push it around and they can go down and trigger stops and do all these sort of things and mess with it. But imagine if someone tried to do that with the stock of Apple. Apple's such a huge company with so much volume. One player can't manipulate the price of that. It's just too big. There's too much liquidity. And then the last thing about liquidity is when there is a panic. When there's a panic, illiquid assets have much worse outcomes if you need to get in or out of them. It's called slippage. So if you hit the button to buy or sell something and it's not very liquid, you're not going to get the price you want. It's going to have some slippage to it. Currencies with lots of liquidity, which are the ones we just covered, you don't get as much slippage. It can still happen, but it's much, much smaller. So we really have to be really focused on liquidity. And that's why we say stick with the 8 foreign currencies, the 4 cryptocurrencies, and this is going to be our choices. And your choice as a trader and your job is to literally pick 2. And your job is to pick the best, the strongest one that you think is going to go up the most during your time period, and the weakest one, the one you think is going to go down the most during your time period. And that's going to be your pairs trade. Let's quickly review pairs trading. All currency trades are pairs trades. All of them. You don't just get to decide, hey, you know what? I really like the dollar. Hey, you know what? I really like Litecoin. That's not what currency trading is. Currency trading is picking 2. Yes, you might like Litecoin, but what are you going to pair it against? The best trade is a trade with the largest differential. So if you looked at all 12 of those currencies and you looked at a one-day performance, the best trade you could have made that day would be to be long the strongest one and short the weakest one. That would have been the quote-unquote best trade you could have made. That was the largest differential between the two. So you need to understand this concept of relative strength and weakness. Just think about this. If you don't focus on this, you might buy the right currency, but if you short it against another strong currency, you're not going to get a return. You actually could have a loss. If you say, hey, I think the dollar is going to be really strong, but you pair it against the yen that's also strong, the problem is you're not going to make any money because there was no differential. So really understand the concept of relative strength and weakness, because everything in currency trading is about this concept. All right, thanks for joining me. We'll see you in the next session.